Dividend investing is one of the most popular investment strategies for individuals seeking steady and reliable income from their investments. While stock prices can fluctuate and provide opportunities for capital gains, dividends offer a more predictable stream of income, which is especially attractive to long-term investors. This strategy is designed for those who are looking to generate passive income rather than engage in short-term speculative investments. Let's break down the concept of dividend investing, its benefits, risks, and how to use it to build wealth over time. What is dividend investing? Dividend investing refers to the strategy of purchasing stocks or other investment vehicles that regularly distribute dividends. A dividend is a portion of a company's earnings that is paid to shareholders, typically in the form of cash or additional shares of stock. The dividend payment is usually made on a quarterly basis, although some companies may offer annual or monthly dividends. Investors who practice dividend investing often target companies that have a strong track record of paying consistent and growing dividends. By holding these dividend-paying stocks, investors can generate a reliable income stream while also benefiting from potential stock price appreciation. The importance of dividend yield. A key concept in dividend investing is the dividend yield. This is the annual dividend payment divided by the stock's current market price. Dividend yield gives investors an idea of how much income they can expect to earn relative to the price they pay for the stock. For example, if a company pays a $2 annual dividend per share and its stock is priced at $40, the dividend yield would be 5%. Dividend yield is often used as a benchmark for comparing different dividend-paying stocks. But it is important to remember that high yields can sometimes be a warning sign, particularly if the company's earnings are not stable or its dividend policy is unsustainable. How dividends work. When a company generates profit, it has several options for how to use that profit. One option is to reinvest the earnings back into the business for growth or expansion, which is known as retained earnings. Another option is to distribute a portion of the earnings to shareholders in the form of dividends. Companies that pay dividends are typically well-established businesses with a history of stable cash flow and profitability. Dividends are paid to shareholders in proportion to the number of shares they hold. If an investor owns 100 shares of a company that pays a $1 dividend per share, they would receive $100 in dividend income. The timing and amount of dividends vary between companies and depend on several factors, including the company's profitability, board decisions, and overall financial health. Dividend reinvestment plans, DRIPs. A powerful way to accelerate wealth building through dividends is by enrolling in a dividend reinvestment plan, DRIP. DRIPs allow investors to automatically reinvest their dividend payments into additional shares of the company's stock, rather than receiving the dividend as cash. This strategy is highly effective for long-term investors who want to take advantage of compound growth. By reinvesting dividends, investors can purchase more shares without having to pay additional commissions or fees, and over time, the reinvested dividends will generate their own dividends, contributing to a compounding effect. The power of compound interest. The key to growing wealth through dividend investing is the power of compound interest. When dividends are reinvested, they can generate additional income, which is then reinvested to earn even more dividends. This compounding effect leads to exponential growth over time. The longer an investor stays in the market and continues to reinvest dividends, the more their wealth will accumulate. For example, if you invest $10,000 in a dividend stock that yields 5% annually, and you reinvest your dividends after 20 years, the value of your investment could grow significantly, even if the stock price doesn't increase at all. This demonstrates how compounding works in dividend investing and why it's crucial to start early to maximize the benefits. Benefits of dividend investing. There are several reasons why dividend investing is an attractive strategy for many investors. One of the biggest advantages is the ability to generate passive income. Instead of relying on selling stocks or other assets to realize a return, dividend investors can receive a steady stream of income, which can be particularly helpful during retirement or for those looking to supplement their income. Another key benefit is the potential for lower risk. Dividend-paying companies tend to be well-established and financially stable, which can offer a level of security compared to more speculative investments. While the stock price of a dividend-paying company can fluctuate, the dividend income remains relatively consistent. This makes dividend investing an appealing option for those seeking stability and predictable returns. Building a dividend portfolio. A well-balanced dividend portfolio typically includes a mix of stocks from different industries and sectors to minimize risk. For example, an investor might hold dividend-paying stocks in sectors such as utilities, consumer goods, healthcare, and financial services, as these industries tend to have stable cash flows and a history of paying dividends. By diversifying their portfolio, investors can reduce the impact of a downturn in any one sector. The key to building a successful dividend portfolio is to focus on companies with a strong history of paying consistent and growing dividends. Investors should look for companies that have a track record of increasing dividends over time, as this is often a sign of financial strength and stability. Additionally, investors should consider the dividend payout ratio, which is the percentage of earnings paid out as dividends. A payout ratio that is too high may indicate that a company is paying out more than it can sustainably afford, while a low payout ratio may suggest that the company is not maximizing its potential to return value to shareholders. Risks of dividend investing. While dividend investing offers many benefits, it is not without risks. One of the primary risks is the possibility that a company may reduce or eliminate its dividend payments. Companies may cut their dividends if they experience financial difficulties, such as declining profits or increased debt. A dividend cut can be a signal that the company is facing challenges and may indicate potential problems with the stock's performance. Another risk of dividend investing is the potential for inflation to erode the purchasing power of dividend income. While dividends can provide a stable source of income, inflation can diminish the value of that income over time, especially if the dividend yield does not outpace inflation. To mitigate this risk, investors should consider investing in dividend stocks with a track record of increasing dividends above the rate of inflation. Tax considerations for dividend investors. Dividend income is typically subject to taxation, and the tax treatment of dividends can vary depending on the country in which the investor resides. In some jurisdictions, dividends are taxed at a higher rate than capital gains, while in others, dividends may be subject to preferential tax rates. Investors should be aware of the tax implications of their dividend income and consult with a tax professional to ensure they are optimizing their tax situation. In the United States, for example, qualified dividends are generally taxed at a lower rate than ordinary income. However, non-qualified dividends are taxed at the investor's ordinary income tax rate. It is important for dividend investors to understand the tax rules in their country and plan accordingly to minimize their tax liability. Dividend investing for retirement. For many investors, dividend investing is a cornerstone of their retirement strategy. Dividend income can provide a steady source of cash flow to help cover living expenses in retirement. In fact, some retirees rely exclusively on dividend income to fund their lifestyle. To build a retirement portfolio using dividend investing, investors should focus on companies that offer reliable and growing dividends. Additionally, it is important to ensure that the portfolio is diversified to reduce risk and maximize the potential for income generation. In retirement, investors may choose to use their dividend income for day-to-day expenses or reinvest it to continue growing their portfolio. For those who need immediate income, a combination of dividend-paying stocks and bonds can provide a balanced approach to generating cash flow while maintaining stability. The role of market psychology in dividend investing. Market psychology plays an important role in dividend investing, as investor sentiment can impact stock prices and, in some cases, dividend payouts. When investors are optimistic about the market, they may bid up the prices of dividend-paying stocks, driving down dividend yields. Conversely, when the market is pessimistic, dividend stocks may become more attractive as investors seek stable income. Understanding market psychology can help dividend investors make informed decisions about when to buy or sell stocks and how to adjust their portfolios to align with market trends. Dividend investing is a powerful strategy for generating passive income and building long-term wealth. By investing in stable, reliable companies that pay dividends, investors can benefit from consistent income while also taking advantage of the potential for capital appreciation. The key to success in dividend investing is to focus on companies with a strong history of paying and growing dividends, maintain a diversified portfolio, and reinvest dividends to take advantage of the power of compounding. While dividend investing carries some risks, including the possibility of dividend cuts and the impact of inflation, it remains one of the most effective ways to build wealth over time. By incorporating dividend investing into your overall portfolio strategy, you can create a reliable income stream and ensure that your money works for you, even in the most unpredictable market conditions. Whether you are just starting to invest or are a seasoned investor looking for a more stable approach, dividend investing offers an opportunity to build wealth in a way that aligns with your financial goals and risk tolerance.